panel is Private or MIC, Making the Right Move in Today's Market. And we have our moderator, Michelle Stecco, VP National Broker Relations, Sherwood Mortgage Group. And our panelists are Aaron Dura, VP Sales and Originations, PHL Capital Corp. Armando Deseri, Chief Sales Officer, Alta West. Jake Bannister, Regional Sales Manager, Glass Lake Funding. Taylor Lewis, AVP, Originations and Strategic Partnerships, Canadian Mortgages, Inc., and Sebastian Cooperhouse, VP Sales, Ontario Sequence Capital. Come on up.
So thank you, and thank you to Michelle. Thank you to the Mortgage Publication for this opportunity, and thank you, gentlemen. Let's get started. So, I mean, we know that there's a current challenging market. We could all agree it's a little challenging out there. How would you describe the current role and of our private lenders in MIC's today's market, and what trends are you seeing that shape that role right now?
I can start, Michelle. So for me, I would say the private space as a whole has certainly become more pronounced. I think historically what we saw from private lending was, clients that had bruised credit, maybe income challenged. It could have been location of the property or, the uniqueness of the asset. What we've seen now actually is that the subset of borrowers actually continue to widen at a fairly rapid rate. So, these are near prime borrowers that are seeking alternative or, private or MIC financing. And I think part of it has to do with B20. I think part of it has to do with interest rate volatility as well as market conditions. But I think there's something to be said for ease of underwriting and flexibility. And some of the trends that we've identified internally is not only a demand for short-term financing, but we're seeing an increasing demand for longer term and duration. And that path to graduation has become increasingly more difficult. We just gone through our first renewal cycle at Glass Lake. And I think we were all shocked by the data. I think we anticipated about 50% of it, 50% renewal rate. Of the 1-year terms that were coming up for renewal, about 70% of it renewed. So what's interesting to see is that that path to graduation has become a little bit more blurred. And I think really what it comes down to is understanding your client's situation. The client that's behind in some back taxes, a 6 to 12 month term probably makes sense, and you can see that path to graduation. Comparatively, if you look at, a client who is a plumber who's been self-employed for the past 5 years, that has a high TDS and maybe doesn't show much income, that client's going to be probably in the MIC and private space for some time. So I think really what it comes down to is understanding your client's story and positioning them with the right lender.
Awesome. Thank you, Jake. Armando.
Yeah, and if I just add to that, I think we're seeing even the credit quality is a little bit better than normal. We're seeing a lot of trickle-down effect from the A and B lenders. Customers are just not qualifying, be it documentation or through the qualifying rate. So that's been a challenge. And I think to Jake's point, we're seeing a higher renewal rate too with us. So I think that's showing that customers are needing a little bit longer term to fix whatever their situation is so they can graduate. So that's another thing that we're seeing as well.
Taylor, do you have anything to add? Or?
Go ahead. I've definitely noticed the same trends that Armando and Jake just mentioned. The overall borrower profile has been evolving as the market has kind of shifted a lot of people into private lending. But with that also comes a changing connotation of private lending. So I would say, let's say 10-ish years ago, private lending wasn't seen the same way it is now. It was seen very negatively. And now it's seen as more of a solution. And it's not supposed to be a permanent solution by any means. It's more of a step in the right direction. But because of the current market and because of where people are being pushed towards, they can still find solutions. Private lending as a whole, when done ethically, of course, hasn't really changed. It's always been a solution where other people couldn't find the solution or they weren't able to qualify for other solutions, and they came into to help those clients in need. But again, as the market shifts, the connotation changes, and there's not an ugly stigma or as ugly of a stigma as long as we all remain professional and keep our professionalism.
Yeah, I complete agreement with what everybody said. The biggest part is you started seeing it years ago. We saw it a lot in the alt space too. And it was, to your point, starting to look at longer terms, because the reality is that you're coming in and they're saying, my exit strategy is going to be 6 months from now, 12 months from now. And when we're seeing is like, is it really going to be 12 months realistically? I think that's really the part where, and Taylor said it best, is that it's making sure everybody's doing the fiduciary duties, doing the right thing, putting the client in a position where there is a clear pathway to get out. And regulatory changes have really shifted a lot of these clients from A to B and B to private. And eventually regulators change will happen at some point. Who knows when that day happens. But even credit quality, you see a better credit quality of clients coming in, but then you're also seeing the impacts of what's going on and how many more people now they're that much more challenged. And then we're all here to figure out the right way to help them to get them where they need to go, so that a year from now they can get out and get back to an alt lender, or potentially even get out to an A lender, or just sell and put money back in their pocket and be able to be in a good financial position. Because none of us up here want to be the lender at the end of it. It's like we're foreclosing, we're selling. Like, we don't want to be property owners, right? That's not our job.
So I guess what I'm hearing is like the importance of education, and I know things have evolved. And sometimes privates can be looked at under a negative connotation, and something that people don't want to hear or admit. So I think there is that kind of evolution on education. But what would you call, like, we have to have our KYCs down packed. So maybe a KYL leads us to, how would you describe the evolution of the MIC or private space, and what are some of the differentiating factors that brokers should know?
Well,
Not all at once. Go ahead, Sam.
Somebody.
Yeah, go for it.
And you're not allowed
There we go. Yeah, no, I can touch on that. I mean, a lot of it echoes the earlier answers. Obviously, the demand from the lending side and tightening banking regulations. But it's important to note that a lot of the institutions in our organization, certainly the ones on this stage, have evolved significantly. A lot of us are very sophisticated in our approach. We want to take care of this industry in the long term. We've got institutional investors, some of Canada's largest banks, giving us operating lines of credit, increased regulation. So the sophistication level, I mean, I've been in the industry for 8 years, and even in that time, it's increased substantially. And it's important for brokers to understand that and also educate their borrowers on that, because they wouldn't know that. They probably have very little knowledge of these names when they see them on paper. So I think that's been massive.
Yeah, I would just say, to echo Aaron's point there, I think private lending now has become more institutionalized. So to kind of Aaron's point, the sophistication around the underwriting, like the DNA of these private lenders or MICs are extremely experienced bank and alternative lending experts, right, that have been in the space for a long period of time. So the underwriting sophistication is there, but there's also the investment in technology. There's the investment in compliance and risk management. So, and when you also see the investment from some of the larger hedge funds and pension funds that are getting into private lending, it's a good sign.
Yeah, and I agree. I think there is a sophistication when it comes to portfolio management. It's when you have a product suite, you have each product that one of our companies offer goes into a certain bucket. And so internally, there is a sophistication when it comes to portfolio management and how we run our business. And so there's an evolution that's happening. It's I think what you're seeing in the space even in the past 6-7 years, it has grown tremendously. We went from under 1% to almost 10% nationally in the private space. In Ontario, I think the private space represents about 15%. So it is a space that's getting bigger, and when it gets bigger, there's a more sophistication that comes in terms of the type of lending and how we run our book.
Yeah, and thing to add to that is funny. There was somebody had said this a few years ago. Private has gone mainstream, and I remember when I heard the quote, I'm like, that's crazy. But if you look over the years now, because if you look at all the institutional investors and how we all run our businesses, we are at that stage. because you can't get to the size that we are without having the rigor and all the mechanisms you need in the background. Like once you're getting to a fund that's 300, 400, 5, a billion, a billion, 4 billion, 5, you can't run it like somebody who has a $20 million book. And as a business, and when you look at all the investors, so especially when they're looking at us and saying we're willing to invest, they're much better educated and they really understand, and they're not concerned about it anymore because I think Armand or Jake said it. They understand our business now, so it has really changed how we can operate.
I like that quote, that private's gone mainstream, because it has, but it's a good thing. It's a very good thing. I'm sure some brokers might find it very frustrating the more questions that we ask, or it might not be as easy as it used to be, but that's a good thing. That those kind of things happen with growth. And I mean, like a new brokerage or any new company, when it's just one person, yeah, no problem. You do whatever you want, when you want, how you want, without any regulation. But now, part and parcel to new rules and just the overall spotlight that is on private lending, we have grown and we have gone mainstream, but that's good to protect the broker, to protect the lender, to protect the client at the end of the day. So the evolution is positive, in my opinion.
Yeah, for sure. And I think there's a lot of prudence around the way we do things in general in Canada on the lending side. So the fact that there's experience, there's tenure, there's growth is very healthy, in my opinion, as well. And for the people in the room that are either newer or even if you have stayed away from doing private lending because it was just too easy, you had a lot of just clean deals coming across your desk. There's a lot more solutions now. And so it's no longer just getting a job letter, pay stub, chasing a rate, trying to find who has the best rate, et cetera. We're chasing solutions, and it's nice to know there's options here. So in a real environment of specialized lending, that often requires brokers to educate and guide their clients way more carefully. What strategies have you seen work best in positioning a private or MIC within the team and within the brokerage?
I can go. I think you kind of touched on it, the solution. I think it's very important that brokers understand that they have to act as that guide for borrowers and really sell them on that solution, the timeline, the goal, the exit, as opposed to just the pricing, right? Obviously, we are priced higher than traditional banks, but majority of borrowers that take alternative financing come out of it in a much better financial situation. And most of us up here are shorter term lenders, right? It's 1 to 2 years. And I think if brokers really stress that to their borrowers and sell that solution, ultimately guiding them along that path is very, very important.
And I think to add to that, I think making the customer feel comfortable with the payment. It's all about the payment and making sure it fits their budget. Because once rate is one thing, but I think when you look at the payment, that's what the customer needs to get comfortable with. And as a broker, you go through that whole process and talk about what the payment would be, how long it's going to be, if it's a year or 2 years, and then more importantly, the exit strategy. How do you get that customer out of and graduate them to a B lender or an A lender?
I think we're all going to say pretty similar things, because when people are watching TV or doing any sort of preliminary research on a mortgage, they're kind of comparing themselves to bank rates. And if they have to go private, you're not getting bank rates. And it's always going to be a little jarring for the borrower. So the best way to position it is the bigger picture, the end goal. It's not to stay in private forever, hopefully, and that's a very rare case to stay in private forever, but it's the end goal. What is this going to lead to put you in a better situation? And when you can kind of build that bigger picture for the borrower, that's probably where you're going to see the most success and the most comfort from the borrower.
Yeah, and I think to add to that is, don't sugarcoat the conversation. Be honest. Like, don't be brutally honest. Like, you don't want to scare your clients completely, but I think the part is there's a full level of honesty, transparency, and really getting them to understand where they are, where they're going, how you can get them there. But the other part we should all be touching on is, okay, so the plan is a year. Well, and if a year's time we can't move you, this is why this partner or this partner, this lender or that lender, this is why they're still a great partner to be with, because the renewal fees are going to be this. This is what's going to happen. So they understand, and they realize as long as you make your payments on time, it's not like you're going to be worried. It's like, is that lender still going to be there a year from now? And that's why picking your partner is so important, is understanding that, will they still be able to renew a year from now, 2 years from now? And what does it look like? Are you going to be dinged with massive fees, or is it going to be something that's really reasonable, the client can work, and then it allows them more time to properly get out of the exit strategy?
So it all comes down to, again, KYL. Take some time. Very, very important. Great points to know your lender, but also not just the front end. So the triage, the upfront underwriting, putting packaging, all that, understanding the terms, the fine print. What does it look like a year from now? What does that exit strategy look like? And what is the flexibility? So knowing your lender really is going to make the huge difference in the end. And I guess what I'm hearing more now than ever is that loyalty is out the window. So a lot of clients that were past clients, repeat clients, and that are now just kind of a little quick to jump the gun and maybe switch for the new shiny penny. When it comes to lenders, where are you seeing the success that they have with these types of borrowers? Like, what is the differentiating factor? Or what is it that's helping them keep their database long term?
I would say for us, where we see brokers having success is, their willingness to adapt to market conditions, and I would say willingness to educate themselves on the different spaces. So, I think those brokers really show resilience in tricky markets like we're in today. I use this example when we first launched. We were dealing with one broker in particular who. I think the bulk of their business, about 80% of it was A business, and kudos to that broker. They recognized kind of the shift in the market and realized there was opportunity, kind of that alt and private space. And they were willing to educate themselves on kind of the private and even commercial, which was shocking. That same broker today is going to go on to do about $50 million with us. So, I think that the broker that's willing to show the willingness to change, adapt, educate themselves on the different avenues of lending, those are the ones that really show resilience in this type of market.
Yeah, and just to add to that, I think, one of the things we hear it all the time, I don't do any privates. I think as a mortgage professional, you have to know every aspect of the business, be it A business, B business, or private. And if you're not, you're missing. You got to look at your top revenue line, and if you see it dropping, and you look at your business and you're just focusing on one segment of the business, I think it's time to adapt and change and learn. And education is important. There's a ton of BDMs here, a lot of companies ready to teach you about the private business. And I think it's just having the willingness to put out there and get educated if you're not doing any, because if you're not, as I said earlier, you're missing out on 10% of potential volume that's out there that you can capture.
And I think the other part is what is great about this space is that you have a client that you have the opportunity to talk with on multiple occasions and literally wrap your arms around them how everybody else wants to. Because if you're looking and saying, here's your 12-month strategy and this is what we're going to do, now it's up to you, Mr. and Mrs. Broker, to honor your side of the equation too. Is like, I'm going to follow up in 3 months and we're going to be here and here's where we need to be. And now it allows you to reach out, have more conversation. And what do you do every time you talk to somebody? You ask for another referral. Anybody else I can help you with? It constantly allows you to ask another question to find out what's going on. But the more involved you are, and you get to create a longer term relationship, because once you get them out of private and you get them to B or get them to A, guarantee they're going to tell all their friends about it and how amazing you were. So I think that's really where brokers have the real opportunity to wrap their arms around a client and build a long-standing relationship and build a bigger network of referral sources.
Great point. Yeah, I think there's always that kind of desire to have a long-term client, and when that happens is when there's solutions that you're providing and taking them from out of a problem and into something better and guiding them through it, and valid touch points, right? Not just, hey, how's your cat doing? It's valid touch points on how the process is going, and are they listening to the plan that you perhaps outlined for them. So great points. So we talked kind of about present day, but we're going to shift a little bit and kind of look into future, which no one I know has a crystal ball for sure. But if we're going to look to future, from your perspective, what's driving confidence and growth in the private lending space? And second part is, what are the challenges that some of the brokers are facing or may face without a crystal ball?
I could go. So, I think sorry, Michelle, the first part of the question again?
Yeah, so the first part is, what's driving confidence and growth in the private lending space?
I think what's driving confidence and growth is kind of where we're seeing the market today, right? So these are near prime borrowers that are, getting engaged in the space and are seeking this type of financing, whether it could be, they're capped on doors with a, certain institution, maybe they're looking to spread out a payment with a 40-year AM, whatever it may be. I think there's opportunity for those types of borrowers. But we're seeing the investment from the hedge funds, the pension funds who are getting more entrenched in private lending. They see the opportunity there. Some of the challenges I would say that brokers may experience is I think the ones that have success, I would say, really understand the liquidity positions of the lenders that they work with. And what I mean by that is different private lenders and mix are funded differently. Some are institutionalized, some are backed by other institutions, some are, syndicated individual investors that pool their money into mortgages. So I think having that understanding allows you to place the deal with the correct lender. The institutional lender is probably going to be more looking at a deal that is more scalable, and whereas you look at a syndicated group of investors, they're probably going to look at more higher yields and more risk averse deals. So I wouldn't say it's a challenge, but I think it's an opportunity, just really having those conversations with your BDMs and salespeople in terms of how are you sourcing your funding, what's the type of returns that you guys are looking for. I think that will better position your client with the right lender.
I think what also is driving the growth of the private space is, for lack of a better term, exposure therapy. With a bigger spotlight and with more exposure to private mortgages, it just naturally will help the whole market grow. I mean, look at the size of books of everybody who's on the stage right now. Like, that's huge growth. That didn't used to be the reality of private lending, right? And there was not a lot of interest in growing private lending from a lender's perspective. So I think that's absolutely driving growth, and confidence also comes from the options, right? There's so many different options for private lending now that you're bound to get some sort of fantastic solution for your client. And it also makes all of us, it drives competition between all of us, because when people have more options, you have to step your game up. There's no ifs, ands, or buts, unless you want to just kind of evaporate into irrelevance, but you have to step your game up. So that's naturally going to grow and going to gain a lot of consumer confidence.
I think these gentlemen covered most of it, but just to add to that point, many of us have increased sophistication in our business, including increased number of products, and within those products, amortization or different flexibility, open, closed, HELOCs. There's a lot of different things in our industry now, as opposed to just the 1 year open with a 3-month prepayment penalty. Things have changed. There's increased competition. There's a demand from a newer set of borrowers, if you will, with excellent credit quality that need fast solutions. So that side has definitely evolved significantly and is driving that growth.
Do you foresee any challenges that brokers should be aware of?
It's a good question. I think back to Jake's point, understanding the liquidity of your lender, understanding their source of funds and where they're coming from to make sure that they are there to be a consistent source of capital is very important. And then ultimately, it's again presenting the solution to borrowers and making sure they are fully educated on the space. Yeah,
I agree. I think if you think of the private space right now, it's fragmented. We have larger institutions, we have some smaller mix, and I think what you're going to see over time, there will be increased scrutiny with the private space as well, and I think you're going to see a consolidation happen, and I think that's only going to create more opportunities. And going back to what some of the guys said up here, you want to make sure you're dealing with somebody that is going to be big enough that can handle those customers, even at renewal, that you're not going to have any issues where that customer is going to get kicked out. And I think that's what you're going to see in the next 3 to 5 years, if not sooner, more and more consolidation in this space because the increase of compliance and regulatory that's coming down the pipe. There's a lot of people who just don't want to be involved in it anymore. And I think it's also, if you don't have the diversified funds to grow the business, that's going to be challenging in the space going forward.
Armando, you almost make it sound like regulators are a thing.
I'm sorry?
Are regulators a thing?
Yes, it is a thing. And even in the private space, there's regulators.
Yeah, and I think even on the broker side, like even for yourselves, the regulators are there. They're looking, and you're all seeing it. I think it behooves every single one of us to make sure that when you're doing every single one of your files, dot your I's, cross your T's, document everything, make sure you have everything there because the regulators are looking. So make sure we all know you're all professionals in this room. You all do amazing jobs. Just make sure you have everything set up so that regulatory wise, you don't have any problems.
No, and I don't think it's necessarily a bad thing. I know sometimes we feel overly heavily regulated, but to protect economics, basic economics from crumbling, I think it's necessary sometimes, especially in times where privates are more prevalent.
Yeah, I was having this conversation with a broker recently, and I said, I've been in this space now for longer than I want to admit.
Started at a very young age.
I didn't have hair then, so I still don't have hair now. So yeah, still long. No, so the reality though is when I first got into the broker space, it felt like the Wild Wild West, and you're in your teenage years. Everybody was doing everything, and everything was crazy, and everything was just everything was moving at lightning speeds and trying different things. Yeah. And over the years, piece by piece, it's gotten tighter and tighter, and everything's gotten into check. And that's really, I look at the broker space, and the broker space has evolved. So we're no longer, it's no longer the teenage years. Now you're in the professional years because the regulars are in, we're all lining up, we're doing what we need to do. You know, people who left the bank space was like, oh, I want to go broker but no, you have to. These are all the things you need to do. And all it does, it helps the space be that much better. And when you're out talking to the consumer, it gives you that much bigger of a leg up because now you really understand, you can explain to each and every one of them why you do what you do and why you're so much better than a bank rep.
Just if I can add to touch on compliance and regulation, I mean, it's not the most fun stuff, but ultimately it's an opportunity. At the end of the day, it's there to protect your borrowers, protect our investors, protect the industry. So I think, the sooner you can get ahead of it and make it a part of your business and really treat it like an opportunity, the better off you will be because we all know it's not going anywhere. It's probably only going to get more and more.
Yeah, for sure. I think some of us were around when it was like, give me your master business license and invoice. Here's your approval. That was a thing.
On a napkin.
That was a thing. But
that was in the B space. It was like that.
Right.
Income on
That was not even in the private. The B space was like that. Fog a mirror. You are approved. Okay.
Yeah, so protecting the consumers and being able to have the confidence, as Sebastian said, to be able to let them know you understand the process. This is why we're asking for the documentation. I think it gives a level of comfort to the consumer who, again, might be a little shy about being in the private space and sharing that. So thank you. And I guess lastly, in the future, if we're going to have to look ahead in the private mixed space, we talked about how lending evolved up until now, lending evolving going forward a few years from now. And again, no crystal balls, so it's all going to be opinion. But what do you need to do to try to stay competitive? I know some of you touched on this a little bit in terms of tech, but anything in particular?
I think innovation, new products is important. We need to always have pricing is one thing. I think service is another. I think turnaround time, that's what brokers are looking for. I think the future in the private space is going to continue to grow. I think it'll evolve. I think brokers, if they're not involved in the private space, they will eventually get involved because they're going to realize that there's opportunities out there. And I think as lenders, we're going to do the best that we can to give the best products, offerings, and provide the best service that we possibly can to make sure that that client can get their house refinanced or purchased. And then at the end of the day, when you look at when we do a private deal, there's going to be another deal. You're going to be getting another deal from that client for a year or two. And that's what you always have to be looking at, that it's not a one and done deal where a lot of your, say, A clients, you put them in a bank, they're done. You're probably not going to see that client come back to you too often. But if on a private, you're guaranteed there's an exit strategy, you're going to take them to a B lender or an A lender afterwards.
Yeah, just to kind of add to Armando's point there, I think it was great, was I think where private lenders are going to differentiate themselves moving forward is around speed and flexibility, right? You know, you're coming to a private lender probably as a second look in most instances. So I think being quick, being nimble, being able to provide that flexibility will be critical moving forward. But I think where we can help brokers kind of within this space is around the education piece. Really educating them around how to structure a deal, what to look out for, and most importantly, I think the most important part of it is how do you communicate that to your client on why you're putting them in a private mortgage. So those brokers that can focus on educating their client will do well, I think, in the private space.
And I think the one piece that a lot of people forget is the private space is not the race to the bottom for rate. And there are times where you see it, but we have to remember in this space is that we all have to price for risk. And if you can't get the yield that you need to get, it's how much access to capital that you have, right? If you can't get the return for the investor, how much more do they want to invest? So there's a balancing act between, I can fully appreciate that you're trying to get the client into the lowest rate possible because that's part of your value prop and one of the angles you sell on. But when you come into this space, rate is not the driving force behind the conversation. It's where they're going. Are you getting them out of the situation? Their payment, and really, rate is just it's part of the ecosystem, but it's not the driving force. And if the push is to drive it low and lower, it's going to create even more it'll create problems in this space because then the space doesn't become as feasible what it used to be, right?
Rate might not be it's not going to be a race to the bottom, of course, but it definitely matters. I mean, look, at CMI, we've lost deals to pretty much everybody up here at some point. And if there's another lender who's willing to do the exact same deal with maybe the exact same friction or lack thereof at a lower rate, the broker has a responsibility to absolutely put their client in that product. Look, at the end of the day, everybody's touched on what's going to help the space evolve, the innovation or the speed or the education. My perspective is that it's all encompassing, like everything, because steel sharpens steel. Like you wouldn't believe how many times, we see something online and we see marketing online and we say, hey, we got to go back to the drawing board. Or, somebody comes out with a new product and we say, well, we got to go back to the drawing board because if other people are doing this, then we need to step our game up. We're all competitive. We're all competitors. I like you guys. I really do. We're all competitors. I want to beat you guys. Sorry, but I do. Sue me. But I think that that's, again, a good thing for everybody in the space, that when somebody does something better, it drives you to do better. And that just helps everybody.
Q&A. We have some mics around the room, so if anyone has questions.
Hi. I have a question that most of the private lenders have a different list for approved appraisers. And, underwriting criteria mostly is on equity. So can we not have something like specific only, like these are the 8 to 10, maybe these are the list of appraisers. I've done a couple of appraisal which fits at Alta West but doesn't fit at CMI. We end up spending more. So can there something be there around that?
Not all appraisers are created equal. So if we've had a bad experience with an appraiser, we can't in good conscience, say, yeah, we'll accept this, because that doesn't necessarily put our investor in a good spot and it doesn't give us a lot of confidence with the value of the property or the quality of the appraisal report. So, like any other lender in any other part of the industry, some people allow appraisers on their list, and some people don't. That's why, one of the gold standards is the home trust list, right? But they're not the only lender out there that has their list of approved appraisers. And there's no difference within, the B space, the A space, or the private space when it comes to our risk appetite when it comes to appraisers.
Yeah, you're 100% right, because I think it really does become what brokers don't see behind the scenes is we could have seen some appraisals come in, and all of a sudden, like the appraisal quality starts dropping, and they could have been a really good appraiser for us for years, and all of a sudden they have people on the team. So for us, we have to step away. And you've been using them for a long time, but at the end of it, we have to make sure that we're protecting the organization, we're protecting investors. So to have something standardized, it doesn't work. Even between the big banks, there's still appraisers that are not from one bank to the other.
Yeah, I would add to that, just to Sebastian's point there as well. Like we're a little bit more selective on the types of appraisers that we're using, and I think it's difficult because in a relatively soft market with lack of comparables and recent sales, it's tricky to kind of go off the appraised value with the lack of recent sales and comps. So, we make sure that we do our due diligence on the report, making sure that it makes sense and the numbers work. But I think it's very important to choose the right appraiser for sure.
So my question is, the 6 major banks, charter banks, over the years, uses NAS. The price of appraiser is like 50% lower than the other appraiser. But you never used it. Is it because, if the charter banks are using them, and it's the same kind of risk, investors' money and everything that they're using, why is it that private lenders will not accept a NAS appraiser when most of the time we started out with the chartered banks, the appraiser, or something went wrong, not appraiser, something went wrong, whatever that is, and now we have to turn to a MIC or a private mortgage. Then we have to go to the client and say, guess what? The appraiser can't be used. And they look at you as, what? I just paid money for that. Why we can't use it? My question to you.
That's a good question. Sorry. What? We take on more risk than the banks. So we have a riskier borrower, right? We deal within a riskier playing field. So just like you said, just like Glass Lake, at CMI, we're very selective with which appraisers that we use, right? Regardless of, the appraisal management company, we want to be very comfortable with the appraisal reports that we get because we are taking on more risk, right? There's actually a higher risk that our borrowers are going to default on their mortgage. We have to take that seriously. We can't just say, well, because somebody else, regardless if they're a bank or a private lender or a B lender or, Joe Blow with $200K in his pocket. Like, we just can't say that just because they're going to accept it, we will. Because we have to protect all of our investors. We have to protect our company as a whole.
Yeah, I appreciate your pain and having to pay for 2 appraisals when it goes down that route. But ultimately, we can't answer on behalf of the banks, but we're equity-based lenders. I think everyone up here, it starts with the property. We need to really have a relationship with our appraisers. We need to make sure that they're scrutinizing those properties the way that we want them to, because we're not income qualifying the way the banks are. We're hanging our hat on that property first and foremost. So, to Taylor's point, we have to be selective and really scrutinize those reports and get to the bottom of them. Whereas, systems like NAS, they kind of blast it out to a large number of appraisers. That simply doesn't work in our space with the way we underwrite.
Yeah, and I think the last piece to this too to add is every lender has their own rules for appraisals. So when they come in, what rules that whatever bank you're using, by the time it gets to us, our requirements are probably different than what they want. So it actually has an impact on the appraisal.
I think it's too managing the expectations of the clients too, just to be able to know that conversation has to happen, in the process. If in underwriting, when the A side is looking at a file, they're looking at covenant, they're looking at the borrower, and to the panel's point, when it comes to them, they're just solely looking at the property and exit strategy. So a little bit of a different risk there. Sorry, was there another question here?
Yes, general question about just the MIC versus private. Maybe just overall, what would be the distinction, and if there is any, why would a borrower or a broker select a MIC and sending the deal to a MIC versus a private?
Great question.
General.
Did you hear the question? Yes.
Yeah, good question. Ultimately, a MIC, Mortgage Investment Corporation, we're a fund where all investors' funds are all pulled together, and then as a fund manager, we lend that out at our discretion. If it's a true private, there's a single or a small group of individuals who have placed money into that single mortgage. Obviously, as a MIC, you're managing the portfolio. Like we mentioned earlier, there's sophistication. We're looking for growth. We're offering renewals. We're trying to take care of our borrowers and brokers. Not to say that a private wouldn't, but ultimately, the decisions come down to the merit of one or a small group of individual investors when you go the private route. You're kind of dealing with different groups of people when it comes to renewal and managing that loan.
I'll just add to that as well. I think I touched on it a little earlier, just in how some private lenders and MICs are differentiated, right? A MIC is an investment corp where it's a pool of investors that pool their money together in mortgages. Us at Glass Lake, we're a little bit different. We're an institutional private, so we're backed by a large global hedge fund called Bayview. So, we source our capital a little bit differently. But each private lender and MIC have different capital allocation strategies. They're looking for a specific return. Where a MIC and private may differ is the capital that they have on hand and the risk that the investor is looking to take on at that given time. They may be a bit more selective on the deal that they want to do based on how much liquidity they have available to them. So I think that's where private and MIC do differ at some points.
Yeah.
So what's the distinction? He's asking what's the distinction for the borrower between the two?
See, the borrower, I think at the end of the day, the borrower, I'd like to think they have more comfort with dealing with one of our companies before they deal with, Joe on the street corner to get a mortgage, a second mortgage or a first mortgage. I think it just gives them more comfort because one, we're regulated, and I think that should give them comfort not only as a borrower but somebody who's investing into a mortgage. We're regulated by the Securities Commission of the provinces that we lend in. So I think for also when it comes up for renewal, when you're dealing with a strict private person, you don't know if you're going to get a renewal from that person. So then that puts that customer in a situation where they have to go somewhere else. And if you think about somebody who took out a mortgage, let's say, 2 years ago at 80% with a declining market, and that private wants his money out, what does that customer do? With one of us, we'll renew it. As long as they paid their payments, we're going to renew that client, no questions asked, regardless of what the value of the property, if it's gone down or up. Or even if their credit's gone down, we're still going to renew it because they've made their payments with us. So those are things that you need to, as a mortgage professional, when you're putting a client into a private, think of those things. You have to think of those things. And that's where it's important when you're dealing with somebody that they're well capitalized, they've been around, they're established, that you don't have to worry about if you can't move them or graduate them, you have comfort that they'll get renewed.
Our time is up unless, one more? Okay.
Yeah, I just wanted to emphasize the pain that we are going through and actually help you all increase your business. You know your criteria, you know your risk factors, you know from where you're getting the source of money, what they're looking for. If we give you a file and you have assessed it, one thing you could do is an AVM, but why can't you all be just like the banks, have your own appraisers do the appraisal and give us back the answer yes or no, so we don't have the pain of telling our borrower, hey, sorry, this lender's not going to do it. We have to go to another lender. We have to get another appraisal. They're willing to pay for an appraisal, but once. So think about it, food for thought. Do the appraisal just like the banks do it. Get your own team Do your AVM and then tell us, yes, we're going to this and we're going for an appraisal. At that time, we can tell our clients, hey, we're going for an appraisal. The final decision is there. I'll leave that with you all.
Food for thought. Thank you, everyone. Thanks to the panelists. Thank you.